Welcome to the first lesson of the Canadian Investors course. Let's get this disclaimer out of the way. The content of all videos and articles produced by the Financial Literacy Learning Center are for educational purposes only. Any articles or videos are strictly for educational purposes only, not a recommendation to buy or sell securities. The Financial Literacy Learning Center website and its publishers are not liable for any investment decisions made by the viewers or subscribers. The author of these video articles does express certain opinions in the contents of the videos or articles, but will not assume any responsibility for the actions of any viewer or reader who acts on this educational information. Investment involves various level of risks, as you'll see in this course. Future results can be dramatically different from the opinions expressed herein. We believe in the use of an investment professional before investing. Not all advisors are alike. We can assist you in matching advisors with what you may be looking for. We strongly believe that the majority of investors require assistance from all investment professionals. We hope you view our video on the investment industry to fully be aware of all the various licensed investment professional types in Canada, along with their fees and or compensations, as well as their services. So by clicking on to read an article, observe video, you've acknowledged that you've read and agree to the above terms of use and disclaimer. Please note, you may not read or use any of the services of this website unless you fully agree to understand the terms and use and a disclaimer posted above. You must read the terms above. So the Canadian Investors course. The FLC, or the Financial Literacy Learning Center of Canada, is strictly in educational business only. Instructors who work in industry are not to discuss their firms in these videos or articles. FLC does not sell any financial products. This course complements Canada's Task Force on Financial Literacy that has been launched by Canada's former Finance Minister, James Flaherty. So session 1, which is the one we're doing today, I'll just give you an overview of all the different sessions and what's in it. There's, I think, 11 lessons here, but session 1, basically we're giving you an introduction, and we're going to talk about income investing. We're going to begin that. And in this particular lesson, we'll talk about short-term income investing. Session 2, again, is an extension of income investing, but we get more into things like preferred shares. We'll talk about dividend tax credit. And then we'll get into a very, very important topic, probably one that's so misunderstood in Canada, and that is the bond market. So we'll teach you how to profit in the bond market. Session 3, Introduction to Equities. Talk about the capital markets, stock market. We'll talk about some commodities. And we'll get into REITs, real estate income trusts, and income units. Session 4, the economic cycle. We'll talk about the economy, how it relates to stocks, bonds, real estate, and commodities. We're going to talk about something called the yield curve, which is a very valuable tool to observe. Session 5, Simple Financial Planning. This is not a financial planning course, and investment advisors can do a good job that way, but we're going to talk a little bit about financial planning from a perspective of just household budget creation. We're going to talk about also a little bit of insurance, annuities, term, universal, whole life, and some various tax strategies. Session 6, which is a very interesting one. We're going to talk about something that Canadians really are not fully informed, and that's the investment industry. Who are the players? Who are all the different types of people that work in the investment industry? What are the licensing bodies that these people are associated to? What rules are they restricted to? How do they get paid? What are the fees that you're charged on everything? I think this is probably one of the more popular sessions. Session 7. We're going to talk about what is called packaged investment product. mutual funds, wrap accounts, and ETFs, exchange traded funds. Session 8 extends the packaged investment product lesson to guaranteed income products, closed-ended units, and structured notes. Session 9, a topic that people may have heard of but don't know exactly what they are, and that is options. We're going to take more of the conservative approach to options. How do options work? Options as a conservative strategy. Options as a way of creating extra income in your portfolio. Session 10, portfolio construction. What is asset allocation? Constructing a customized investment portfolio. And then finally, session 11, different investment strategies. We're going to talk about some of the controversial products that, while may not be controversial as far as in the last 25, 30 years, but may prove to be controversial going forward, i.e. a balanced fund, for example, and why it could be risky going forward, where the future may be. And we're going to talk about something that's going to be very important in the days and years to come, and that is rules-based investing, which may be the key to making money going forward. So let's start. So what's investing all about? Well, investing involves some level of risk. I guess we can call it risk investing versus guaranteed. We all love to talk about growth investing, but growth investing involves taking risk. Let's just call it for what it is. That is risk investing, where you can lose some money. We all want to make money, but you can lose it. Versus guaranteed investments, where you know what you're putting up, you know what you're going to receive, and you know what you're going to receive at the end. That's guaranteed investing. Investing helps manage inflation, hopefully. Investing attempts to grow your money. And investing does involve knowledge, patience, and what's very, very important, and that is discipline. Let's look at some of the objectives that are involved in investing. These are the kind of questions you should ask yourself. So, safety of principal. We all talk about how much money we want to make in a portfolio, but maybe the first question you should be asking yourself before you do anything, besides guaranteed investing, how much money are you willing to lose? Just envision that as you're about to invest it. We all have a certain degree of risk. We're willing to take. Some people are more riskier than others. Do I need income in my portfolio? Income received from your investment. In other words, am I buying this strictly for income? Or maybe do I need some income just to help augment the portfolio along the way? Do I need growth? Want assets to grow? Which again involves non-guaranteed investments like stocks and real estate and precious metals and commodities, etc. Do I need liquidity? Is the portfolio able to raise cash or switch between investments easily? Can I press a button and sell my investments? Or do I need to put a for sale sign on the lawn and wait maybe, who knows, depending on the market, a day, a month, a week, 2 weeks, 2 months. And then there's knowledge. Know what you're doing and know what you own. There are too many times when people just hand their money over and say, well, go ahead, invest it for me. And they nod their heads, pretending that they understand. That's what these courses are all about. They're not going to teach you everything, but they're going to give you a good background and the type of questions you should ask before you go see an investment professional. Very, very important, because in the end, it's your money, and if something goes wrong, well, you're to blame, not just the advisor. And then one important topic here is access to product. Put yourself in a position so that you're not restricted to the investments that you need. And these courses are going to teach you about the different products that are available to investors. And that's the other problem that we have out there, is that with the different types of investment professionals, they're restricted in what they can sell you, for example. And as a result, you end up just knowing those products when they may not be suitable, or they may not be what you want. So by the time you finish these lessons, you're going to understand all the different types of investments that are available to Canadians. So what is risk? Well, there's different types of risk. There's liquidity risk, as we just talked about before in the previous slide. In other words, the ability to get in and out. Okay. Can I sell the investment? Can I sell part of the investment? Do I need some money today for something else? Um, so it depends on the type of investment. If you're going to buy, for example, a common stock or a bond, well, you can literally sell that investment as fast as you can press a button on your computer. If you're going to, let's say, buy a rental property, well, yeah, they're liquid, but they're not liquid in 2 seconds. And there's a process involved. So if you need liquidity, well, then choose your investments wisely. There's interest rate risk. Well, what does that mean? Well, interesting enough, way back in the 80s when interest rates were, between the 13 to 15% area, and that was on the first half of the 80s. Some people bought a lot of Canada Savings bonds. Canada Savings bonds were yielding 16, 17, 18%. But, Canada Savings bonds only give you that rate for 1 year. But you could have bought, and you'll see actually in lesson 2, government bonds, government guaranteed bonds for 1 to 30 years. And you imagine making 16, 17% for 30, 40 years. You could have done it that. You could have done that. So the reverse is this too. Let's say you're about to renew your mortgage. It's a big decision. Do I stay with a variable rate, which is very low, or do I lock in for 5 years? That could be a big difference over a 5-year period. The 5-year period gives you certainty. Well, whereas you're kind of gambling with the variable rate, assuming that interest rates will never go up again. So that's a little bit of an explanation of interest rate risk. Inflation risk, well, this actually affects a lot of seniors out there because they do have a certain amount of fixed income and they need to live. So inflation is probably one of the most important factors that a portfolio must tackle. In other words, can I grow this portfolio, grow this wealth, at least enough to cover inflation? Reinvestment rate risk. Well, if I'm receiving an income investment, a GIC or a bond or whatever, and it pays me X amount of dollars every month or every 6 months or once a year, well, that cash that I receive, what rate will I reinvest it at? Well, that's where your reinvestment rate risk. If you buy, for example, a compounding instrument, then there is no reinvestment rate risk because you know what the rate's going to be on a compounding basis. And then, unfortunately, then there's bankruptcy risk. Companies do go under. And so we've got to do our homework. And again, there's a lesson here that helps you with that. But bankruptcy risk is probably one of the biggest mistakes that a lot of investors make. They fall in love with an investment, it turns around, something goes wrong, it falls, and they keep saying, well, when it goes back up again, I'll get out. And it goes lower, and then when it goes back up until finally at the very bottom. Like a company like Nortel is a perfect example. So here's a chart of risk range. The highest at the top being riskiest and the bottom being the most safest. Obviously, futures and options, which we're not going to get into a big way in this course. That's the ultimate in risk. You can make a lot of money, you can lose it all too. Common shares, real estate, precious metals, probably the next category. Preferred shares, which we're going to talk about in the next lesson, is a pretty conservative way of generating income. There's corporate debt, or we call them debentures. Then there's GICs, which you can buy in financial institutions. There's government bonds, there's money market funds, and then there's treasury bills. And treasury bill is the safest investment that you can buy in Canada. Age can relate to tolerant risk too. You can see the younger you are, the higher you can tolerate risk. When you think about it, though, a 35-year-old that is married with a couple of kids and a mortgage maybe can't tolerate that much risk. I think what this is telling you is they have time. If something goes wrong, they have time to recover. A 71-year-old does not have time to recover when something goes wrong financially. So, fixed income investing. This is where this starts. So we divide fixed income investing into different terms. And we're going to be talking about the short-term one today. But short-term fixed income investing, or maybe guaranteed investing, is defined as any instrument that's goes for 30 days to 5 years. Medium term, 5 to 10 years, and long term, 11 to 30 years. Now, this may prove a little unusual for people because we've been trained ever since we're kids that 5-year GIC is long term. But in the fixed income world out there, and you'll learn as this course goes on, that's part of the short-term part of the spectrum. Okay, so those are the definitions. So short-term fixed income investing, 30 days to 5 years, interest-bearing investments. So what's offered out there in the Canadian market? Well, there's Canada Treasury bills. There are provincial treasury bills like Ontario Treasury bills or Alberta Treasury bills. There are term deposits, which you get at the bank. There's an instrument called bankers' acceptances. There's corporate paper. Money market funds. We're going to talk about the Canada Savings Bonds, Ontario Savings Bonds, and GICs. Again, as I mentioned before, why is 5 years short term? Because there is life beyond the bank account. Interest-bearing investments available to Canadians range from 30 days to 30 years. The bond market, as we call the bond market, is a 2 to 30-year entity. Treasury bills. So here is that's the safest investment in Canada, and 100% guaranteed by the government of Canada. That's why we say, CDIC insurance, Canadian Deposit Insurance Corporation. Why don't we need it? Because if the government of Canada can't pay on treasury bills, then all our paper is useless. We must throw it in the fireplace. So you don't need insurance. So in actual fact, it has an unlimited amount of money that can be guaranteed by the government of Canada. Whereas at the bank, you're insured up to $100,000. Again, it's the safest investment in Canada. And it comes in different maturities. 30 days, 60 days, 90 days, 180, 360 days. The 90-day one is the most popular one. So how do you buy a Canada Treasury bill? You choose the maturity and the quantity and then determine how much you want to invest. Treasury bills, or T-bills we call them, are bought at a discount. So, about 100 years ago, the way it used to work at the bank is if you decided to buy a $5,000 GIC or a term deposit, for example, you didn't give the bank $5,000. They asked for a discounted amount, and then it matured to $5,000. And treasury bills also match that traditional way of buying things. Now today, and it's a lot simpler at the bank, obviously, you give them the $5,000, you get paid interest, and you get paid back $5,000 plus interest. But the government decided to keep the old tradition. So follow this example. Let's say we want to buy a $25,000 90-day treasury bill at 3%. So 90 days from now, this thing will mature. So what will it cost me to buy this treasury bill? And the answer is a $25,000 T-bill matures in 90 days will cost $24,821.21. So you give the government $24,821.21, and in 90 days you'll get back $25,000. The difference being interest income. And if you work that over an annual basis, it'll work out to that 3%. I know that 3% looks good right now. Unfortunately, those aren't the rates. I just chose that as an example. Now, bankers' acceptances and corporate paper and T-bills are all bought and sold the same way. So what's a banker's acceptance? A banker's acceptance, or a BA, basically is a form of paper offered at the bank. You can buy it through brokerage firms. And they basically, I guess they would take a lot of small short-term debts, 90-day, 100 days, 300 days, sometimes 6 months, and they would bundle them into this paper. These are companies that, you and I don't know. They're not really rated. So why do we buy these? Well, the rates tend to be a little higher, and the BA is basically guaranteed by the bank. So if, for example, if the interest rate might be 2.5% out there for, let's say, for a year or 6 months, the bank would charge what is called a stamping tax, which is about 0.25% to the company, and then they would take the responsibility of guaranteeing that paper. So $100,000 denomination is the minimum that you buy, but then you can buy $1,000 after, so you can buy 101,000, 102, etc. Corporate, and they're bought just like treasury bills. They're bought at a discount. Corporate papers, same as BAs. This is basically corporate debt. Oh, and by the way, the banker's acceptance, remember, is guaranteed by the bank, not by the Bank of Canada, by the bank that you deal with. So you might have Royal Bank corporate paper, Toronto Dominion Bank corporate paper, National Bank corporate paper, etc. They guarantee it, not the government. Corporate paper is the same as banker's acceptances, except you're actually buying the corporation. You know it, and it's rated. For example, in Canada, Loblaws does a lot of corporate paper, or General Electric, or Canadian Tire. So Canadian Tire might need a few $1 million, for example, for 90 days. You can go on the open market and buy this, usually through the brokerage houses, and they will provide you with that paper. A lot of this is done on any business day, usually before 11 o'clock in the morning. So whatever a treasury bill, which is the safest paper rate is, you'll find that a banker's acceptance might pay a 1/4 point more, and a corporate paper might pay a 1/4 point above that. So that's why you buy corporate paper, because you can make a better rate of return than the treasury bill, for example, or a term deposit. And you have to judge, whether you think a Canadian Tire will have a problem in 90 days, which right now we doubt. And then for the smaller amounts of money, we have money market funds. And there's all kinds of them out there. The banks all offer them. The mutual fund companies offer them. I think the insurance companies also offer them. Just make sure that when you buy money market funds, that these are insured, that they're under the Canada Deposit Insurance Corporation, period. And you never buy more than $100,000 worth, period. So, when we go back to this corporate paper, banker's acceptance, or they say the corporate paper, and say that's where we have to worry about the credit rating. Well, in Canada, we have a rating service, and this paper, this money market paper, is rated as an R factor. So R1 being the best, R2 being okay, in between, and R3 being riskier. You'll get a higher rate, interest rate, from an R3 than you will from an R1 paper, obviously. And within the R, there's R high or R low, R1 low, R1 high, R1 low, or R1 high, R1 low, R2 high, R2 low, etc. From most investors, or perhaps in your perspective, just stick to the R1 paper. So when you're going to buy corporate paper and you're talking to an investment advisor at a brokerage firm, for example, the language you would use is, I'm looking for, let's say, $100,000 of 90-day R1 corporate paper. And they'll know exactly what it is, and they'll choose the companies, and they'll tell you, well, they'll give you choices of which company you want to buy into. short-term investments. Again, Canada Savings Bonds, Ontario Savings Bonds, term deposits, and GICs. Okay, so Canada Savings Bonds are premium bonds. Well, they're safe, just like Treasury bills. Unfortunately, Canada Savings Bonds are no longer available for sale. But what Canada does offer is a Canada Premium Bond. And this competes with the 3-year GIC at the bank. So they're available October, November. When the rate comes out, take a look at it. Because, again, you can put as much as you want in there, and they're very, very safe. And they tend to be a 3-year term. Compare that to what a 3-year GIC is doing at the bank, and then shop accordingly. That's if you need to buy an investment for 3 years. But the beauty of this instrument is they tend to be redeemable anytime. So you're at the GIC, you're stuck with it. So don't ignore this instrument if you're looking to buy an investment up until 3 years. Okay? If you can get a higher rate on this versus a 3-year GIC, well, there's no decision to be made by the Canada bond. Now, here's an example of Ontario Savings Bonds. I'm not trying to be biased, but I just happen to be from Ontario. But there's other provincial bonds, and there's similar rules. Ontario Savings Bonds are safe, secure investment, and they are 100% backed by the province of Ontario, not Canada, the province of Ontario. And they include both principal and interest. They're available in annual or compounding interest. So you buy the instrument, you can buy one that pays interest once a year or one that's compounding. The compounding one's good for an RSP. The fixed rate is a 3-year fixed term. That's one particular type of bond. The second one is a step-up rate, and it runs for 5 years. And what happens is the rate increases each year. So it may start at, let's say, 1.5% in the first year, maybe 1 3/4 in the second year, 2% in the third year, et cetera, et cetera. And then there's the variable rate bond, and that's where the rate is basically reset every year for 3 years, depending on what's going on out there. And GICs. I think we're all familiar with these. Now you buy a GIC from the bank, your trust company, or credit union, and it's like you're lending them your money for a while, basically. If you think you may need your money back early, buy a GIC that allows you to change your mind without any penalty. And that type of GIC would be a cashable GIC. And they tend to run for a year. You may have to invest at least $500 as a minimum. Fixed terms such as 6 months, 1 year, 2 years, all the way up to 10 years. With some GICs, you need to get your money back sooner, as we said before, but you won't earn any interest. You can sell a GIC on the open market. The ones you can sell are the annual pay GICs, but you may not be happy with the price you get when you sell it. Because remember, you're selling it back to the same bank. And you may have to pay a fee or a penalty. And then there's CDIC, Canadian Deposit Insurance Corporation. Now, I mentioned to you that GICs can run up to 10 years. CDIC insurance only covers GICs up to 5 years, period. So if you're buying a 10-year GIC, it is not insured. It is guaranteed by the underlying bank. And can I insure more than $100,000? That's a good question. Because what happens is, basically, the CDIC covers up to $100,000 at a bank. And let's say, for example, let's say Bank of Montreal, for example. This is you could have a $75,000 GIC at the Bank of Montreal, and let's say you have a $45,000 term deposit or a savings account. CDIC is not going to cover all that. They're only going to cover the first $100,000. So if something goes wrong with the bank, for example, not that we're saying there's something wrong with the bank, but if something goes on out there, you're only going to get the first $100,000. The rest is at risk. And that's a very important question. Actually, it's given what's in here we are in the first quarter of 2016. That all of a sudden has become a very important point with what's going on around the world. Did you know you can have up to $2 million in GICs that qualify for CDIC insurance? And you know what the irony is? It's at a Canadian bank-owned institution. So you have to ask. There are, in the bank, or part of the bank, divisions where you can go and put, if you're lucky enough to have all that kind of money and you want to sleep at night, and you want to make sure every penny is guaranteed by the government of Canada, well, you inquire, you set up an account, and actually you don't pay any fees because the institutions pay these individuals the fees. But how do you do $2 million in let's say, 5-year GICs? How do you get that all insured by the government? Well, because they have access to 20 or more financial institutions. So you put $100,000 in each one. So you put $100,000 in the Royal and the TD and National and Canadian Western Bank, or all the different institutions that are on their screens, and you can shop around, and it's great. And you just have to ask. Every bank owns one of these entities. So I'm going to talk about what is going on today. There is an unusual part of history, and I'll tell you what has been going on, particularly in Europe. Remember 5 years ago when we had the financial crisis, and the American banks were bailed out, which, good or bad, it happened, and they're not in bad shape today as a result of it. Sure cost the taxpayer a lot of money. But the Europeans have decided to do something different called a bail-in system. And if you recall a couple of years ago when Cyprus defaulted and the banks were all going under, they decided to try this bail-in approach. Maybe it was the Euro community that used it as a bit of a test too, but the way it worked was that the government insurance, and in this case it's euros, they will cover 100,000 euros in your bank account. If you have more than that, then you're not insured. So in a bail-in system, the bank's common shareholders lose all their money, the stocks, which is fine, and the bondholders lose everything. And the first $100,000 of depositors is insured by the government, but after that, the bank is allowed to take money out of your bank account to help supplement the repairing of that bank and bringing it back into good financial shape. So in the case of Cyprus, what they did is any money beyond 100,000 euros, they kept 10%. So if you had €1,000,000 in the bank took away 10% above the 100,000, which turned out to be 90,000 euros. So you had to give the bank 90,000 euros. Not so good. But guess what? Very quietly, the European Parliament in Brussels, starting January of this year, 2016, has passed, should I say, a bank bailout system for the entire Euro community. And I've got some websites here. One's with the CDIC that pretty well answers all the questions that we talked about, maybe a little bit more. And then there's other articles there on what's going on in Europe. This is very, very important. There's a lot of things happening out there. So, you ask yourself, why place yourself or your family in an exposed position when you don't need to? Now you're educated, and now you know better. Can this all happen here? Well, I hope not. But there's some real, things going on out there. Deutsche Bank, which was the gold standard of banks, especially in the 80s and 90s, is in trouble. They may go under. They may need a bail-in. No one would have imagined that. Were there any Canadian banks during the 2008-2000 financial crisis that required taxpayers' dollars to help them out? That is a wonderful homework question. And when you find out, you're going to be surprised. So, as we said in the disclaimer, we teach these lessons basically, and then we kind of throw a few things at you just to just to give a better commentary on what's going on out there. This is a very, very interesting chart. It's a keeper. It's a 10-year U.S. Treasury chart. These are 10-year bonds. These are the yields, I think, going back all the way to the, I think, 1910, 1912 area. And you can see where we are right here. Well, look at, there's the 1930s. So we actually have, the Americans, and our 10-year bonds are similar, we actually have the lowest rates in history. This is that period in the early 90s when interest rates were up to the middle teens, 15, 16, 17% area. That was terrible. Imagine getting a mortgage at that time. But then, rates kept coming down. They go up a bit, and they come down and go up again until finally we're at where we are today. So this is a very troubling time for income investors because when you think about it, we're approaching zero, and there's a lot of risk here. Do you really want to lock in your money for 10 years at this period or more? And when we learn about the bond market, you're going to get a better appreciation for this. Here are 5-year Canada bond yields. Incredible. We're all the way down to 0.5%. And that's where they were back in 1981. I think they got as high as 16.5 to 17%. And then this is what followed. And here we are again at 0.5%. Now, you hear about the Bank of Canada rate, and in the U.S. you have what is called the federal funds rate. This is what the central bank sets. Very, very unusual period because we've never seen this before. Look at this period that I've highlighted here. You follow my cursor. This is a federal funds rate for the last 6 years. It's been almost zero, and recently they raised it to 1/4 of 1%. When you see that as an investor, that's not a sign of health. It's a sign of desperation. So you're trying to somehow kickstart the economy. And a lot of that has worked in the States, maybe at a tepid way, but that's what happens with the central bank. And they have this phenomenal power to do this. And this is mostly not the rate that you and I can borrow from, but what the banks can borrow from. And that went a long way towards repairing their banks. But you can see here, again, from 1981, I think at one time their Fed funds rate was exceeding 22%. And look at the dramatic fall we've had ever since 1981. And now we're at this point here, which, to be honest with you, none of us have seen before. This is our version of that Fed funds rate. We're not at zero, but we're at 0.5%, but we may be heading to zero. In fact, I wouldn't be surprised if by the end of the year, the Canadian rate might be under zero, maybe minus 0.1 or 0.25%. I know that's hard to understand, but we'll talk about that in other lessons because this is a very, very important point in history. And you must learn this. You must understand what this means. Because if you do the right thing, you can make a lot of money, but boy, can you get hurt if you do the wrong thing. So what is an income investor to do? What happens if you own bonds or debentures today? What if you just own bond funds? Or you own an investment called an income and growth? Or you own you're being managed by a so-called very conservative fund? If you own anything that has the word yield in it, high yield, whatever, investment grade yield, what should we be looking for? Well, the next lesson is very, very important in helping you decide these things. You're going to realize that perhaps you might be heading for a problem if you don't do anything about it. Thanks. Next lesson, go for it.